want, if perfect. All right. So, yeah, without further ado, Van, you want to give us a little rundown of who you are and what you do, and we'll go from there.
Yeah, so my name is Van Carlson, founder and president of Strategic Risk Alternatives, known as SRA. My background is really in risk management. It's an exciting part of the business world, but I've been doing it for almost 30 years now. And I'll be honest with you, I do enjoy risk management. A lot of business owners, business owners always have to think of the upside, right? I mean, it's really important, especially when you're starting out. And so one of the things I'd like to do with clients is kind of keep them from stepping into some landmines, potentially. And that's really what a risk manager does. We think traditional insurances do a very good job with a lot of the tangible assets of businesses. Unfortunately, I've seen over my experience of being a risk manager, a lot of the risk lies inside the intangible assets of the business, and that's supply chain, brand protection, some of the things that came to light last year, for example, in COVID-19. So that's where I kind of focused my risk management in. I grew up through traditional insurances, ran a pretty successful property and casualty agency. Just like every entrepreneur or business owner, you wear all the hats in the beginning. Over time, you peel the hats off. And really, the hat I kept was working with business owners. And just like you guys, I mean, I think they're the lifeblood of our country and truly the risk takers every day, much more so than somebody running a Fortune 500 company, right? So the kind of advice we want to bring to our clients are kind of institutional type ideas that we're trying to make it to where it's affordable and really understand risk business owners take every day and how do you manage that risk more effectively. And so, and we work with a lot of professionals all over the country, but my background is really in risk management and taking this idea of how do we manage this risk more effectively to where you can weather storms like what happened last year in COVID-19.
Excellent. Excellent. Very good. So specifically, SRA, do you guys specialize in something known as an 831B entity? Is that right?
Yes. Yes.
All right. Tell us a little bit about what's going on with those.
Yeah. So 831B is a tax code, just like the 401k is, right? In fact, I tell business owners there's only two tax codes that allow you to defer income in your business. One is a 401k, which is for you and your employees' retirement, and an 831B is one to manage self-insuring risk. The 831B came in existence in 1986 under the Big Tax Reform Act of 86. It was introduced back then to create an incentive for business owners to manage their self-insuring risk. And what was really happening back then was farmers were self-insuring crop insurance. Private sectors, when I mean private sectors, for-profit insurance companies were getting out of it. It became too volatile, no different than an earthquake-prone zone or hurricane areas along the Gulf Coast, right? So and FEMA has, the government programs. But so a bunch of senators got together, they came up with an incentive, because the thing about self-insuring risk, it's not a deduction. If I bought general liability, work comp, commercial insurance for my vehicles and all that, that's under a 162 line item deduction. I'm transferring that risk to a third party. Mm-hmm. But a lot of the risks I have to retain. I mean, again, I keep referring back to COVID-19, but I don't think there's more glaring incident in my lifetime for business owners that risk that they took that were really self-insuring the risk. Political risk, brand protection, supply chain risk, all those good things. Those are self-insuring risks. Well, if I took $1 and set it aside for those potential risks, that's not a deduction, right? The year you incur the income is the year you pay the taxes under an S Corp or LLC or C Corp for that matter. So Congress came out with this incentive to create no different than a 401k incentive, right? If the incentive is not, if I made contributions to a 401k retirement plan for my employees, I couldn't deduct that, then why would I do that? I mean, there's no incentive for the business owner to do that, right?
Exactly.
Well, same thing for an 831B. There's plenty of incentive to own some kind of form of your own And we call it an 831B plan, but it's a box that needs to look and feel like an insurance company. Now, just like a 401k administrator, we're an 831B administrator. Just like a business owner would go out and hire a 401k to administer their plans, you have to have the same thing on an 831B as well. And that's what we specialize in. And, you know, there's rules and regulations, no different than the 401k. There's been a lot of case laws of abuse under 401k tax code. And, you know, with abuses become clarity. If you were to Google 831B today, you would see that the IRS has won 4 cases surrounding this in the recent years. All of them dating back since 2008. Unfortunately, a lot of them just came to light in the last 2 to 3 years. It takes that long, I guess, to get to tax court and get a brief from the judges. But most of that, though, had to do with estate tax planning. You know, like you got to love the attorneys. You know, we're Americans. We're innovative. We challenge everything that's put in front of us, and nobody likes to pay taxes. And so, unfortunately, the tax code was hijacked. It was hijacked for estate tax planning, and it was great estate tax planning. It was fantastic. It's one of those things where it was too good to be true. And in the 2017 PATH Act, they eliminated some of those issues with the estate tax issues. And we could talk about that another time. But in essence, the court cases were surrounding very, very wealthy people trying to devalue their estate. This box was not owned by them. It was owned by their irrevocable trust or their grandkids or whoever. And they were able to transfer a substantial amount of wealth through them. And the IRS seemed to see that to be abusive. So abusive that it just wasn't being ran properly. And, you know, there's a 4-part test to owning these things. Again, we as the administrator of the 831B plans, that's our job. That's our responsibility to our clients. And we feel we do a very good job with that. We're all risk managers that, for the most part, that work for my business, for my company, SRA. And we hire the attorneys, we hire the CPAs, but there's nobody like that in-house. We hire the best of the best when it comes to that. But we're risk managers, no different than 401k guys managing 401k plans that are financial advisors. They know finances. We know risk. And that's what gives us the benefit and the advantages in this space. That's why we own 831b.com. That's our website. You know, and so we've been doing this now for 12 years, and I feel we're pretty good at it, and continue to be good at it. So.
Excellent. So let's say I'm a client or a potential client, and let's just use some numbers to make this easy. Okay. So let's say that the client has $10 million of gross income, because that's just an easy round number, and is operating at, say, 30% margin. So net income is going to be around 3 million, and they're grossing about 10. Give us just a rundown of how would this play out for that client, and what are the benefits? What are the risk benefits? What are the tax benefits? And how would that play out?
Yeah. So from a strictly, so there's a 4-part test. You have the transfer risk, distribution risk, fortuitous risk, meaning you can't insure things that are business risk related. And then the 4th one is you have to act on principles of an insurance company. Mm-hmm. And so that's one thing we want to make sure clear to all of our clients. There is some distribution of risk, which means you can't own 100% of your own risk and call yourself an insurance company. There has to be some element of distribution of risk. And again, we're handling all that. We got really nice videos for clients to look at it. They're animation videos. So we're told by the marketing people, they will hold your attention longer. That's what we're told. That's what we pay for. So we're hoping, but there is an education level to this for sure. So, you know, the benefits to the client is really managing risk more effectively, utilizing deferred taxable income. Like I was saying earlier, you know, if I just took that dollar and set it aside, well, I have to pick that dollar up as income. You know, I can lose up to 50% of that, right? Depending on what state and federal tax rates I'm in. Well, if I got to keep my, you know, I'm self-insuring risk, would I rather do it with after tax money or before tax money? Mm-hmm. And of course you'd absolutely want to use pre-tax dollars. And again, that's why the tax code exists. Congress recognized that back in 1986, and they continue to, by the way, too. They support this tax code. So all that aside, that's one thing. The big tax play, and I call it the big tax plays because it's a simple arbitrage. First off, you're deferring taxes. Okay, that's great. And I can fight the fight if I need to down the road. I don't have to rely on PPP. I don't have to rely on going down to the bank and getting an increased line of credit because now I'm being sued or I'm having issues with my supply chain, so I got to go out and go to another vendor or supplier or whoever. I've got money in the back room that helps support that from profits from previous years. A very, very efficient way of running a business, I must say. Again, this is what big companies do all day long. This is how they operate. There's a reason why Amazon never pays taxes, I'm told, right? I mean, there's just kind of structures put in place for these guys. And we're trying to bring it down to the small to middle market business owners so they're aware of these tools and they can, and again, by the way, it's a tool. For the right client, it's a great tool. And that's all this is. It's not a rocket ship. It may sound like a rocket ship at times to clients, but we're trying to make it as simple as possible. But the big arbitrage part of it is this. I can defer taxes. I can fight the fight down the road if I need to. And if I have to, if I sell my business, I walk away from it. I close my box down, which happens to be a C Corp. So the big tax play for strategists are moving income, taxable income and ordinary income rates to a capital gains or dividend rate. And that's the play. And obviously fees go a big long ways in that, Jeff, to make that work. And we're very sensitive to fees. We know the fees have to make sense. One of the biggest knock on this program was, it was so expensive to do at one point, it made it to where it was not affordable. It didn't make sense. Deferring income didn't make sense, right? So again, this is a tool that we think all business owners should at least look at, and the ones that makes sense for, they should be doing it. It's critical to the business. But that's the big tax arbitrage play. We hope our clients win on that. We don't know. I mean, you guys deal with it all the time too, right? We don't know if this thing's going to be here's an investment that's going to kick off dividends. But we hope that long-term dividends stay lower than ordinary income rates. But again, we don't know. We have no idea what the future holds on that. All I know is a business owner can defer taxes today with the opportunity down the road to move to a capital gains or dividend taxes. And here's the beauty I would say about all this program. The client, the business owner, picks the day he pays the taxes on the money, right? So if everything goes well, he has underwriting called underwriting profit inside the box, the insurance company, and he pulls it out as long-term capital gains, and he wins. Good for him. But that wasn't what the purpose of the program was, or is. But the rate of return, I think deferring taxes is a big deal. Be able to fight the fight with substantially more money if you need it. And if everything goes well and everybody's lost control, stay in line, and we don't have these types of losses, we don't have other events like COVID-19, they'll be able to hopefully win on the back end with capital gains or dividends. Again, it's a crystal ball. Every administration likes to kick that around. But the good thing is, you as a business owner, you get to time that. I don't know when else you can time it. Even on 401ks, they're going to force you at 70.5 to start drawing it out, right? So that's really the long-term play. And then, of course, there's planning opportunities in the back room, and that's why we work with guys like you and your departments, and really the strategies that be able to do in the back room that this provides you. I think, we've been witness to it. It's been a life-changing event for a lot of business owners.
Very good. So let's say that you are a business owner, and whether your revenue is 2 million or 5 million or 10 million, and you're learning about 831B, and it's time to start setting aside some money for alternative risk. Okay, so we're going to set up an 831B entity. And we've obviously got to do a risk assessment with them to find out what the premiums are going to be. Can you talk about kind of how those premiums are calculated? Are they calculated, in relation to gross revenue, or how's that work?
Yeah, it's all based on gross revenue. I mean, one of the things that business owners always get on their renewals for their general liability or any of that kind of stuff is what was your gross revenues. And of course, the idea is as your gross revenues grow, your exposure for risk grows with it. That's not necessarily always true, but that's what the insurance industry likes to say.
Right.
But we've adopted that, right?
It's an acceptable standard.
Exactly. So we've taken that gross revenue in, and we've very much mimicked our program over the very insurance coverage that started this, and that was the crop insurance.
Mm-hmm.
A lot of people don't know this, but typically, if I'm going to do, and crop insurance is an income protection policy. It's as if I sold the crop, right? And at historical prices, meaning basically over the last 3 years, whatever the price of bushel of grain was, that's what I'm gonna get if I get destroyed through a hurricane or drought or tornado, wipe my crop out. That's what crop insurance is, and infestation and all that good stuff. So it is an income protection policy. So we look at our stuff the same way because we really look at the self-insuring risk that business owners have, and a lot of it has, one common thing, and it's business interruption. And so when we look at that, that's the same thing we're doing. So we've adopted some of the formulas the crop insurance industry has. We don't believe a lot of the actuarials that are done today through this program are done very, very poorly, to say the least. And the biggest reason is this. In order to make the predictable model in actuarials, you got to have thousands of data points.
Mm-hmm.
Well, if nobody's really tracking brand damage, nobody's really tracking supply chain risk, and traditional insurance companies aren't submitting claims, they're not creating a database like you would have like an automotive or a clue report for homes. You go buy a home today, you'll know if there was a water damage 10 years ago because there was an insurance claim on that.
Mm-hmm.
Well, as that data builds, now you can start to price things out, and you can make a predictable pricing. The problem in today's world is a lot of things we're talking about. You can't make it predictable enough pricing because the reality is nobody knows. Traditional insurance companies don't want to offer this coverage because it's too volatile. And so we just basically come out and say this: listen, we'll give you 10% of the ceiling. This is the ceiling. No more than 10% of your gross revenue per year, but no more than 2% per coverage per policy. So this is getting a little bit in the weeds, but I'm okay with that. This is not proprietary. I mean, this is our rules and regulations, and the rest of the industry out there can do it differently.
So for a client who might be listening to this for the first time, if you have $1 million of revenue, that would mean up to 100,000 could be put away in premiums. And if you have 5 million, up to 500,000, if you've got 10 million, up to $1 million could be put away for alternative risks in a program like this.
That's correct.
Excellent.
That's correct. Provided we have enough risk in there. But I tell you, risk is not the problem. We can find a lot of risk, unfortunately, that you're self-insuring for. So yeah, you're right. Now the other thing I would say on that is we also have a solvency issue. And what I mean by that is we have a thing similar to I don't want to get too much about the technical terms in our industry, but the modified endowment and life insurance, where we have a solvency test. We do the same thing for the insurance company or for the box. So if we start to overfund this, and it typically starts to appear after year 5 or 6, we may require the client to either take on additional risk or some other things that we can do, or we may require them to take a distribution if they want to keep funding at the level they've been funding. We again, this is internally our program. These are rules that we set forth, but we think it's good rules based on where we're at today with the tax code 831B. And I think it's a good rule. We just have standards and rules in place internally that we put in place that, based on our experience and relationship with attorneys, that make a lot of sense. And so those are just understand in a good 401k same way, right? I was talking earlier. There could be forced distributions if we keep overfunding. If we don't have claims, the clients aren't having their own, something along those lines over the next 4 to 5 years, we could look at a distribution part. But those are things down the road that we work with clients every year on, and but it is our rules.
Well, your rules help keep people out of trouble, right?
Absolutely, I think so. Unfortunately, guys, with the IRS, what in some cases, we hope they come out with some better guidelines. We hope they come out with some safe harbor rulings. The code's not going anywhere. This is a big business code. I mean, big businesses use this code a lot. And so, but it would be helpful if we had some more regulations from them, certainly. We're not afraid, like I said, we've been doing this now 13 years, and we're not afraid of, I mean, if we're doing something wrong, we'd like to know. We've never been even reached to or talked to by the IRS.
Well, to that point, have any of your clients been audited, and what were the results of those audits, if you don't mind sharing?
No, yeah, happy to. So we've never actually had we've never had an 831B plan get audited by itself. It could have been triggered due to an operating audit, where let's say the operating company was being audited due to whatever, a big deduction that they were in question, or they did some R&Ds that were questionable, or
and so that's an important point, is you've been doing this for 13 years and none of your clients have been audited because they did an 831B.
That's correct. In fact, we've had clients that 831B got pulled into the audit, and we've never had any changes due to that.
Right.
We've submitted.
So some of your 831B plans have been the subject of an audit because the return was getting audited for other reasons.
Correct.
And in all such circumstances, it was a no change audit as to the 831B.
That's correct. That is absolutely correct. So, yeah.
Excellent.
Yeah. So we feel like we're doing a lot of things right, and so that is good.
Okay.
And I should mention too, Jeff, real quick, one of the things that because we feel so confident in our program, we offer a warranty to our clients that if they were ever to be challenged as an 831B, saying this was not a legitimate box, this is not a legitimate insurance company, we would trigger the audit. We actually have audit insurance policies. We trigger those coverages. Also, we would bring our own legal team in. We feel we have some of the best minds in this tax code. They either worked as a prosecutor or a chief counsel for the IRS enforcing this tax code, and they've gone into private practice. We work with 5 different law firms that are tied to that. So again, those are the folks that write our legal opinions. So those are the ones that we consult with. We actually go through mock audits with them just to make sure we're not doing anything that we shouldn't be doing. And then 2, we're always sensitive to our marketing material. We want to make sure the business owners, and it's crazy today. I mean, when I first started, it was a lot of incentive to do for the taxing. I get that. And that's Congress created that incentive. You and I didn't. But that aside, in today's conversation, it's about risk mitigation. You never know how volatile or how naked you feel until your insurance policy doesn't either cover you, or a government agency says you got to shut down and you're out of business for 4 months and you have no choice.
Mm-hmm.
You never really feel how vulnerable you are until those things happen. And so today the conversation is about risk management. It's about how do you manage this risk more effectively and better for your business, better for your employees, and better for the customers you serve. And an 831B, there is no better plan than that. And that's what really, the best compliment we get from our clients that's been with us for a while is, I just sleep easier at night knowing I've been in your program for a number of years. And that gives us a real fulfillment. I mean, it might sound cliche or dorky to say that, but from a professional level, when you tell business owners that have taken risks, entrepreneur minded, just pedal to the floor all the time, and they sit back and say, I can sleep easier at night knowing I've been with your program for a number of years, that's a great compliment. Love to hear it.
So with regards to that, a new client that comes on that's eligible for an 831B entity type strategy, what is A to Z, start to finish? What is the process?
Yeah, so kind of like what Jeff alluded to, we do some due diligence. There's a intake form they have to fill in. Obviously, we want to look at their websites. We want to look at their gross revenues. If it's a really unique industry that we're not familiar with, we would even want to look at some of their GL policies, professional liability insurances, any of the insurances they have out there, and then 2, ask the client what he's worried about, right? So that's one thing, and then we'll start the process. I mean, to form the box, the 831B plan will take 2 to 3 weeks. And during that time, we'll get to know the client a little bit more. But once that box has been built, then it's got its own EIN number. It's its own living, now it's a C Corp. So now it's basically an individual, right? It has its own ID number, not like a pass-through, an LLC or an S Corp. It has its own EIN number and it has its own tax returns. And there's no pass-through, right? It's not going to go to another shareholder or go out as a member of an LLC. And the biggest thing is this. I don't know if I've hit this on, and I apologize if I haven't. The biggest thing is the premium you put into the 831B is not taxed. The only thing that is taxed is investment income, dividends. I bought a stock, I sold it, I paid the difference, and I paid the capital gains on it, right? So that's what that C Corp will pay taxes on. But once we form the insurance company and got it through the pipeline, then we talk about premium payments. Do you want to pay monthly, quarterly, annually? Do you want to have an investment advisor manage the reserves? All those things, we move along that pipeline, and we certainly like that pipeline to be built out prior to our company receiving any of those premiums or those funds. Because one of the ways that we make the best promises we can make to our clients is to get the money into those accounts as quick as possible. And that's what really takes. So from soup to nuts, it's going to take 3 to 4 weeks. And once it's done, it's done. And once the train's on the tracks, we're not here to complicate business owners' lives by no means. We're their admin. We may reach out to them 3 or 4 times a year, but it's not one of those things that becomes a daily grind that adds to their daily grind. Let's put it that way. We should be a complement to their business and not a complexity to their business.
And so in terms of some of the things that your admin fee covers, you mentioned audit protection.
Yes.
Does it include tax returns at the end of the year?
Oh, yes. Thank you. So the C Corp itself has to have its own tax returns. So we do. So to form these insurance companies, to form the box, it's going to cost you $5,000 to form it, and to maintain it, it's going to cost $5,000. And out of that $5,000, there's a domicile fee you have to pay, and then taxes have to be filed. And that's a one set fee. We manage it again as your admin. And then there's some additional fees involved when it comes to retaining risk. And so when there's risk being issued and all that good stuff. Again, we got some really good videos on that I think will do much better justice than I could do it right here. But so it's a very transparent fee structure. I think it's important for all business owners to really know what's costing us, what is it going to cost. And so we're very, again, guys, we're very sensitive to the fee structures because I believe this is going to become a normal business practice. How that looks and feels down the road is who knows. We know fees have a tendency to get beat up when competition comes into play. And we're seeding that a little bit. But we still feel like we're the low cost provider at 5-star service. And that's something we pride ourselves on. And again, I'm here for the mom and pops and the small business owners, the middle market business owners that take a lot of risk, and they're just not aware of these things because they avoid their attorneys. Their CPAs are limited on ideas, what they can really do for them, and they're not even aware of these kind of things exist out there. And that's the kind of things that we need to bring an education level to all these business owners.
Excellent summary. Excellent. Very good. Jake, do you have anything else? Anything we missed?
How does a client mess up an 831B?
Taking money out of the account without telling us. They'll get fired.
Okay.
We are very we're open to everything. It's the communication part's important. Nobody gets to treat these things as a tax deferred checking account, taking money in and out. Unfortunately, we've had that happen, and we've had to disengage from clients. Gotta love business owners. A lot of them are risk takers. A lot of them are just, and sometimes, they take too much risk for us, and we'd rather just send them down the road. The thing about, the clients, when we see a lot of, and I mentioned CPAs earlier, I think one of the biggest objections we get from from our business owners, financial planners, property and casualty agents even, and our biggest referral source also is from CPAs. But however, you know, the challenge we all have as consultants and business owners is dealing with that CPA. And unfortunately, you know, we call them the 831 Google experts. You know, they Googled it, they didn't know about the tax code. Their business owner brought this idea to them, said, hey, do you know about this? And they Googled it and they became an expert over, you know, 2 hours of reading articles. And
you can learn a lot about how flat the earth is on Google as well.
Yeah, exactly. Good point. And so that's a real challenge for us. I mean, and sadly, you know, business owners put a lot of stock in their CPAs. And you know, what's funny is I've had more. The CPAs that I would say are tax planners are really. They tell me that, you know, unfortunately, the IRS looks at CPAs as their partner, because the CPAs in our tax, the way our tax in our country, they're the ones truly enforcing the tax code, because of the liability they take on when they do sign those tax returns. The laws are written specifically for that reason. So sometimes you just wonder, are you really getting unbiased advice from a CPA when these are the things they worry about? You know, one of the things I talk about when I talk in front of groups and all that, I said, you know, I can assure you your CPA does not lose sleep at night if you have to pay more money in taxes. They don't lose sleep because you lose sleep over that, but they will not. I promise you, they will sleep like babies because of that. And that's a real problem in today's world with the risk, the amount of risk business owners take. They're just not getting the kind of tax advice, you know, the president of Amazon's getting, or any company you can think of that, you know, has 500 employees or more are getting this kind of advice all day long. And to me, it's an injustice in some ways. I mean, I hate to, you know, I feel pretty passionate about it, because it's like, man, these CPAs, especially 1 or 2 partners. I mean, I'm like, you started with this guy. He has one. I've had 2 incidents now in my career where the CPA passed away unexpectedly right before the tax returns. And I had so many business owners scrambling to try to get their taxes done. I'm thinking, you run a $10-20 million business and you got one firm with 1 CPA in it? That seems kind of crazy. There's risk. That's a ton of risk. But anyway, so that's one of the things I really don't want to. I do beat that up pretty significantly with CPAs, as you guys can tell, and God love them.
It's a good thing I have 2 hats, right? I'm a CPA and an attorney. So
well, there you go. Oh, there you go. So you're special. But Jeff, we're having this conversation because you're different. I would call you the unicorn, right? I mean, truthfully, I mean, it's not that it's not that they don't care. It's not that they don't want. I don't envy CPAs. I mean, I think it's a tough life.
It's a tough job.
It is.
But how much about 831B is taught in 4 years of accounting school or 1 year of graduate school in accounting? How many classes? 0. Yeah. Most CPAs have to do 30 to 50 hours of continuing education every single year. How many times have you seen CEs on 831Bs?
If we're not teaching them,
very little. Yeah. So mainstream education for CPAs, which is typically a 4-year degree in accounting plus 1 year of master's, right? And then the continuing education requirements that they have that are offered from the traditional like AICPA types, it's not covering these topics.
No.
And so really, CPAs have to go outside of the mainstream educational component to even find information like this.
And you know, one of the things that we work with advisors all over the country, and again, CPAs are our biggest referral source. I'm just going to, you know, it's kind of an oxymoron I'm talking about, so unfortunately, but really it's a great tool to come into a CPA firm with and educate them on, because you're absolutely right. If you can learn this, understand this tax code, and bring this value asset to them, because it's no different than a CPA firm referring to a 401k administrator. Mm-hmm. You know, they're going to refer you to, you know, if they know and trust you, they're going to refer you business if you're a 401k administrator. And it's the same thing for this. And so I think it's a great way to leverage your knowledge, your experience under this tax code, and absolutely went over some CPAs. I think, again, our best referral source and our best clients come from CPAs, and you know, and we work with them all over the country. It's just we don't work with enough of them. Let's put it that way.
Good way to put it. Good way to put it. Very good. Very good. Okay. So when we post this in the Tax Masterclass, what we're going to have is a panel where we're going to have contact information and the best way to get a hold of you guys. Is that going to be a telephone number or an email address or a link to the application to fill out, or maybe all three?
What do you, how do you guys see it play out? What's the best way to do it? All add, any way possible, or?
I think what would probably be best if we had Clay's information in there, because he's really good at coordinating with our office. And so Clay at 831b.com, Clay's phone number, whatever he wants to list. And we even actually, Jeff had a conversation about doing a special calendar link that would land on Clay's calendar. And it would land there in such a way that it coordinated with the other events that he has scheduled. We need to take a few steps further down the road with that discussion to make sure that we can do that, but that would probably make things really easy if they could click through the funnel and then land on Clay's calendar, and Clay would know that it came from us.
Yeah, it'd be great.
Yeah, I think that would work. I think one thing, Jeff, that as you guys were talking there, is the conversation comes up all the time about making sure that, at the end of the day, whether the advisor recognizes it or the CPA or the business owner themselves, these are nothing more than risks that they're going to bear themselves no matter what. It's just, if we have the ability to set dollars aside to manage these risks, and there really has never been an event that's legitimized why these programs exist more than the past 18 months has. With the political risks and the supply chain interruptions and the business interruptions, losses in revenues,
And
all
interruption,
risks. Yeah, all recognized to the business owner themselves. And so if they're going to recognize that as a risk, self-insured risk, whether they view it that way or not, if there's a way to set those dollars aside into a program that provides them a way to manage those risks more efficiently, while at the same time recognizing some tax benefits for doing so, it's a win-win. It's a no-brainer program. Yeah.
Yeah, absolutely. 100%. Yeah, it's the amount of risk in today's business environment is mind-boggling when you sit down and think about it. I was reading the New York Times article this morning of the Democrats came out with their tax increase proposal this morning. Did you guys see that?
I've read it a couple different times.
Yeah.
I don't know. Were they more specific now this time?
Yeah,
around?
they were more specific with the exact rates and kind of the breaks and things like that. So everything from environmental risks to governmental risks to it's all there. It's all there, and business owners deal with it day in and day out.
Yeah, for sure.
One of the things that I'll probably edit this and clip it in somewhere. But is there a kind of a floor on where this strategy makes sense?
Where it doesn't make sense probably is
how little of a company becomes too little.
Yeah.
Yeah. So what's the floor if we're going to have an evaluation with and be able to draw what may not be a black line or a red line, but at least kind of a gray line of from here down, they need to grow a little bit more before we begin thinking about this strategy. And from here up, it's likely a good idea.
Well, it used to be a lot easier to answer. I used to say, 80,000 or more, if you can't contribute to the plan, the math doesn't work. With the fees and annual maintenances and everything else. Today it's not as easy because I've got dental practices that will do $30,000 a year. And that $5,000 is fixed. It doesn't matter if you put in $2 million or $30,000, that $5,000 is fixed. So lower that number becomes, those maintenance fees and the risk retained liability fees become meaningful.
Mm-hmm.
Does the math work? And so, but we've talked to these dentists, we talked to these practitioners, then they basically said, listen, I appreciate all that, but right now, if I don't, this forces me to do something. This gives me the ability.
Forces me to put, have 25K net setting
Yeah.
there aside for risk.
Yeah. And truthfully, I mean, it's the incentive to save.
Mm-hmm.
Guys, think about it. I mean, we deal with it all the time with all sorts of clients. There is 0% incentive to save any money in our country when it comes to business. It's all about accelerated depreciation, right? Buy more stuff.
Buy more stuff. Yep.
Yeah, and this is an incentive. This program is a forced incentive savings plan.
Yeah.
That the government, Congress has given you.
Mm-hmm.
And again, it's frustrating for us because it's like, at least to look at it. If you don't like it, then walk away. At least be educated about the process, the understanding of it, why it exists, all those things, and not be so quick to judge. But unfortunately,
I had a conversation with a client the other day, and their old CPA had recommended pretty much every year that they buy more inventory or take advantage of the bonus depreciation on buying a new car or something like that. And so I had to walk them through that. Yes. Okay. Let's just assume 50% tax rate, state plus federal, just to make the math easy. Right. But let's say that you bought $100,000 car and you bonus depreciation that entire $100,000. And because you're at a 50% tax rate, you just save 50K in taxes. Right. But if you put that vehicle on a 5-year or 7-year loan, at 5% or something like that, you're going to end up paying $135,000 back. And you save 50K, but you're over 5 to 7 years, you paid $35,000 in interest expense, right? So there's every type of tax strategy typically is going to involve some expense or another. And what I love are tax strategies where people get to keep their money and they don't have to give it away.
Yeah. Well, Jeff, just so you know, one of the reasons when I was in 08, the reason I got into this program, I knew about this 831B. And I really, I was busy. I love fourth quarters because all my business owners would call up. They had they still have special financing programs for equipment. Hey, lease it for the next 10 months. All those lease payments will go towards your down payment when you buy the equipment in the fourth quarter, assuming you had a good year, right?
Mm-hmm.
And so they literally would go out and I love the fourth quarter. They'd call me, hey, my CPA says I owe money. I'm gonna buy 2 skid steer and 2 more trucks. What's it gonna cost to insure? Well, heck, everybody's making money, right? Got but then 08 came around, and to your point, when you think about it, it's a form of insanity because I had a really good year. I went out and bought more stuff. I financed it, which means I'm betting.
Instead of building a buffer, I
Yeah.
just eliminated my buffer every single year.
Well, more importantly, I just took on more risk for next year because
Yep.
next year's got to be better than this year because I got to support debt that I can't write off anymore other than the interest payments.
Yep.
And it's just, how crazy is that? And that's one of the things I always like to end my, if you're having a good year, just to take a little bit off the top and park it off to the side is just not only great risk management, risk mitigation, it's just good business. It is just good business.
Common sense.
Yeah, absolutely.
It goes back to those primary principles of put money in a piggy bank because someday you might need it. Saving money for a rainy day, but through a business and getting a deduction for it, it only makes sense.
Yeah. Oh God, yeah. Yeah. If people really dove into this and understood it, yeah, there's some hair on it because unfortunately we had a state tax attorneys out hijack this code. But in essence of what it was supposed to do is what we're using it for. And we could prove that from last year. We made a big difference to our clients that were with us in 2020. We didn't see it coming, believe me. Nobody did, right? But, we were able to perform with our clients. And again, we got money back to our clients faster than the PPP program did. And we're proud to say that. So
As a closing note, perhaps share a story about 2020 and perhaps a client without identifying them or anything like that but help us understand how this was a benefit to them besides that of a deduction, but how they benefited during the rainy day that occurred.
Yeah, so we had a pretty substantial supplier of certain mercantile product. I don't want to dive too much down that road because people can figure out who it is, but that basically was dependent on China for that product, and it was really it was a B2B product where, you know, I brought it in to the U.S. and I sold it to other businesses, and they manufactured a product out of it. And unfortunately, there was a lot of contracts involved. And when China shut down due to COVID-19, he couldn't get his product anymore. And he had to literally pivot to other suppliers, but he was still being held to the contracts and the timelines back here in the US. And so he ended up air freighting his product. It cost him over $300,000. Mind you, pricing's already put in place. Everything that's lined out. You know, there was no way to go back to those other business partners and go, listen, it's costing me this. I need to jump my, you know, they didn't want to hear it. I mean, he's dealing with some very, very big companies and they weren't going to hear it. He said, no, you signed the contract. Nowhere in there did it say if freight went up, we were going to bear that cost with you. And so he had to eat it. And he literally told us, he said, it wasn't for this program. He's been with us for 4 or 5 years and he could weather that storm due to those substantially huge increase. He don't know how he would have stayed open. And, you know, those are triggering events. And of course, that fell under the supply chain risks business owners have that you can't buy traditional insurances for. And so that was a big thing for at that point. I mean, again, a proof of concept, everything that we've been telling and talking to clients and business owners over the last several years came to fruition last year. And that was just one example. I can tell you that we had over probably a 1,300% increase in claims last year, all related to COVID. We had business doctors. We have a lot of medical doctors that were forced to shut down. They had PPP, but you know they wanted to keep some of their employees around. See, that's the difference between a direct loss and an indirect loss in traditional insurances. You know, if it's an indirect loss, you're not going to have coverage under business interruption under a office business operating policy, a BOP policy. And so our policies allowed the way we designed our box. You can put a claim under that and get reimbursed out of that box back to your own operating company. And again, you know, that was a big game changer for a lot of, and it really drove faith in what we do. And so, but yeah, I can go on and on about those stories, but yeah, and we continue to see them this year. Unfortunately, we're starting to pick up more supply chain type claims. We think disputes are coming next. Unfortunately, lawsuits. I think there's going to be, who knows? But what I see a lot of different people being sued over different issues when it comes to COVID-19, and it'll be interesting. We'll see what happens over the next several years. So,
you know, I tend to agree with you. One of the things that we might end up doing now is making good use and good work of this video, and then we might do a follow-up video in a couple weeks, just to try and capture some of the things that as we go through and we dissect this video and make use of it, and then we post it as a finished version on our Tax Master course. We'll likely get some questions, some feedback from the people viewing it, and then we'll do another course. It might be 2, 3, 4 weeks down the road. In the meantime, Clay was going to put us in touch, or maybe Van, if we can get in touch with Nate that presented. Yeah. Because for those people, 2 million and above gross revenues.
I texted him, just so you know. He said, yeah, just let me know. So I just needed to coordinate with you today on the time. And he's totally open to that.
So, what do you think about Andy for that call, Clay?
I actually think that's a great idea.
So Andy's kind of the founder of IRE. The only thing is he's in London.
It's not a problem.
I know, but he has a very, very heavy. He's a humorous guy. You guys would love him. And he's an interesting cat. Very, very strong British accent, though. It's like, holy crap! You got to like really listen to him. Are you speaking English, buddy?
Yeah, right. Yeah. He'll tell you he is that we speak the wrong time, whatever, right?
Yeah, exactly. But that's an idea. Nate's good too. But Andy, you know, if you already reached out to Nate, that's cool. You probably shouldn't hurt his feelings.
Well, let's get both, right? Because then we can chop
Good
it up
idea.
and take the best from either. We just have pretty packed schedules, but if we can get them sometime in the next couple of weeks, I think that'd be very beneficial. And Jeff, they work with Lloyd's of London and some others to help provide consolidated insurances through coordination with 831B.
Right.
So if somebody like that trucking company that's spending $200,000 on insurance expenses, quite likely they could consolidate some of their insurance expenses through Lloyd's of London for a smaller price, and then put the difference. So maybe 100,000 through Lloyd's of London, and having a very comprehensive insurance policy that covers all the same thing that they're paying for currently through a traditional carrier, and then 100,000 into their reinsurance company. So they are starting to self-insure, but half of the premium goes towards Lloyd's of London that then covers all their current risks. So they are consolidating, but also self-insuring at the same time.
So go ahead.
Ben, did I explain that right?
You did. In fact, we're going to have on the 23rd of this month, we're going to have a webinar just for that product. But Jeff, it's doing traditional insurances. So it's doing the work comp, general liability, commercial auto, and property businesses. And it's really designed to clients with good loss ratios that, hey, I'm willing to take on more risk. How do I do that? I mean, this program is a great solution to a lot of business owners that run a very, very clean operation that maybe don't have substantial turnover. Good risk pay for bad risk, right? Well, if you're a good risk and you want to take on more of your own risk and stop giving all this money to the insurance company, this is a great answer. And you get A-rated paper still. You meet all the contracts to be on job sites. I mean, all of those things are still met with the paper from and Lloyd's of London they're a big conglomerate, as you know, and they own a lot of American insurance companies. And so you're using still an American company here in the U.S. You still have A-rated paper, but in the background.
But I was going to say, you do bring up a good point in the sense that we shouldn't use it for that client that has so many claims they can't get it anywhere else. We use it for the client who is a good risk, that it makes sense. So they're paying 200,000. Let's let them pay 200,000 again, but they get to keep half of it in the reinsurance company, and the other half they can get a better price through Lloyd's because they have a good record, because they have good safety.
And don't kid yourself, they're taking on more risk to do that, right? So that 100,000 is first at risk, and then they actually have an aggregate 4 times that limit. So basically, in this situation, it'd actually be at risk for up to $500,000 in the first year. But the beauty of our program is put the 831B in place, have good underwriting years, have profitable years, and now you're able to build up those pancakes, we'll call them, layer it up, and man, you're in such a better position than your competitors, because your competitors are going to have to pay the same premiums you are, but you're doing it in a way in the back room. You're taking 50% of it and putting it in your back room in this other thing that nobody knows about or hears about. I think long term, the competitive advantages are huge for business owners that run a clean. Things happen, outliers happen, claims happen, and all that. But to your point, Jake, it's got to be a clean company. 5 years in business, combined loss ratio 20% or less. Could have an outlier claim depending on what's going on, but that's really the hardened down underwriting rules. Great program.
I was going to say, IRE actually won't even entertain the client with a loss ratio higher than 40%.
Yeah. Hey, Jake, did you notice you and I are drinking the same thing?
I did, but I didn't want to highlight it because Jeff and I usually drink the Purple Monster. Anyway,
I thought you were a Monster guy. I was like, I'm drinking a Red Bull. You wouldn't even drink a Red Bull with me when you were up here last time.
I know. I was just so rude, wasn't I? It's because I'm in Cancun, Mexico right now, and this is what I can find.
Oh, really? That's good to know. Yeah, I love this. What is this? What kind of, tropical. Of course, it's what you would find in Cancun, the tropical flavor.
That's right.
Well, gentlemen, this has been excellent. I think this is going to be a really big part of our program, and I'm looking forward for our clients to get a hold of a lot more of this information. I think we can kind of cut the recording here, but I wanted you guys to know I have about